Good afternoon and welcome to the Coinbase Institutional Markets Call. It's October 10th here in New York, and we're excited to bring you the latest round of news from the crypto space this week. We welcome back Sid, who's been out for a couple of weeks. I think you were a little under the weather and also at a conference. Are you back on top form, Sid?
Yeah, glad to be back.
Good. We're looking forward to hearing about your insights from the conferences that you were at. Today, we also have a special guest, Cosmo Jiang, portfolio manager at Pantera Capital, where he's responsible for their liquid token strategies. Cosmo has spent 12 years in TradFi across a number of really interesting roles, from M&A to PE to long-short equity strategies, and is now in crypto. So, Cosmo, welcome to the show. Looking forward to hearing more from you later.
Great. Thanks for having me, Ben.
Yeah, super excited to hear from you. And then the rest of the team, we have, as usual, David, Greg, George, and as mentioned, Sid, covering what else has been going on. This week, we're going to be going through positioning, important dates around the Grayscale appeal, which is coming up this week, ETH versus BTC, some of the macro dates and times to look out for, flows, Frch, Arb, and so much more. So a lot to cover. We'll get right into it. But before we do, one quick piece of housekeeping. If you are watching the call on YouTube, don't forget to scan the QR code to view David and the team's fantastic research. If you are listening on podcast, that information will be in the show notes. And no matter what platform you're on, please don't forget to like and subscribe. That's how we go up the ratings and more people can learn about the content that the guys are putting together. But without further ado, George, let's kick off with you with a bit of a market update of what's been happening in the last 7 days.
Yeah, sure thing. Thanks, Ben. So overall, I'd say markets were mostly trading in a sideways fashion with relatively contained volatility, although we started trading in a more risk-off mode with the conflict escalating, obviously, in the Middle East over the weekend and yesterday as well, which saw altcoins underperform, in particular yesterday. Equities, if you look across the TradFi, being under pressure, and U.S. government bonds in demand as a safe haven. And as typical for risk-off situations within crypto, we have seen a consolidation of BTC, with BTC dominance rising to just a little bit above 51% as well. Now, outside of that, still struggling a little bit with a couple of key technical levels across the space. So again, looking at BTC, there were some attempts over the end of last week to rise above the 100-day moving average. It's just a little bit above $28,000, which so far have failed. But having said that, I think there was a lot of talk recently about a local bottom in U.S. equities after the correction, and with correlations rising between crypto and equities recently, some talk about a potential squeeze higher in crypto, although in light of the increased geopolitical risk, I'd probably be more careful with that.
Interesting. And I guess, George, ETH versus BTC has been a pretty interesting one. A lot of clients are commenting on that at the moment. ETH has generally underperformed. Staking rates, returns rather, are also reducing. Like, why is that, and how should we be thinking about that?
Yeah, 100%. So ETH over the last week has been down almost 4.5%. BTC more or less flattish, very marginally up, like 0.3% up over the last 7 days. I think sort of looking at the big picture, there's a couple of reasons. The main one, I think, is, in my opinion, positioning. ETH was, and probably still is, one of the biggest consensus themes this year, going all the way back to January and February. So I think positioning in ETH vis-a-vis other crypto assets has been relatively heavy. And Bitcoin, with the ETF theme since the summer, was, in relative terms, gaining some more popularity again versus ETH. And I think that has definitely sort of created this backdrop on the one hand. And then if you look at the, so that's sort of the macro picture, and then the micro picture is last week, I think, the week ETH futures ETF launch. And if you go to the next slide, just looking, at the 30-day 25 delta spread between BTC and ETH, and one particular thing that was interesting and noticeable since the ETH futures ETF launch. So essentially, what we're looking at here is basically, relatively speaking, if implied vols are higher for puts, versus calls for ETH and for BTC. And you can see that typically implied vols are higher for puts and for calls, especially in the current environment, which is more uncertain. For individually, for both ETH and BTC, we are in the positive territory with these lines there. But if you look at the spread, you can actually see, especially over the last week, since that ETH futures ETF has launched, ETH put demand and implied vols have been going up by quite a bit, which to me suggests that there has suddenly been a pretty drastic increase in demand for downside protection in ETH versus Bitcoin, just on the back of that, let's face it, relatively lukewarm ETF launch.
Interesting. And we'd love to bring you in here, Greg. Obviously, George has given us a perspective from a vol perspective, but what about futures? What are we seeing there, and also transactions on chain?
Yeah, so I mean, futures, I think we talked about it last week. In ETH, front month has been trading below spot from time to time, which suggests there are shorts in the name. I think, ETH it's in a bit of a tough spot here because it's shaping up to be a rather attractive short. The crypto native folks will look at it and say, transactions are down, it's gone inflationary. And that's why, I want to either de-risk or possibly be short it. And meanwhile, the more traditional asset managers will look at it and say, well, now we're in a much higher rate environment. We had 10-year at almost 5% not long ago. I want to be short, super long duration risk assets. ETH is one of those. Those same people likely don't want to be short Bitcoin just because of all of the ETF catalysts. So I think that's why you're seeing Ethereum under pressure like it's been the past couple of weeks. So, until something changes either on the risk front or with the protocol itself, maybe transactions tick up, we could see it continue to be under pressure.
Great, thanks, Greg. Cosmo, we'd love to bring you in here. If we kind of look at this from the perspective of kind of fundamental valuations and cash flows coming from that as a result of things that are happening on chain, curious, how do you think about ETH as an asset?
Yeah, look, I think Ethereum is probably one of the most clear tokens that have found product market fit in crypto. Right, you think of it as a global computing platform on which most decentralized applications in crypto and data transfer or ledger updates are done, and so that's pretty powerful. They are, the way it accrues value is that it's actually, I like to think of Ethereum as blockchain's toll keeper, in the sense that anytime you want to interact with an application or anytime you want to transfer funds, you are using Ethereum and you are paying a transaction fee denominated in ETH, and so in that way they're a gatekeeper and collect a fee every time someone uses blockchain. About 90-95% activity in crypto happens on Ethereum or EVM related ecosystems. Relating that to value and where we see it today, I mean, Ethereum has pulled back meaningfully from the highs, even though adoption continues to be trending upwards relative to the trough. And so we're continuing to see pretty strong fee growth. Ethereum right now is annualizing about $2 billion of annualized revenue, which flows through to token holders via buybacks. That's you could argue that that's pretty expensive relative to current valuation. It's about implies that Ethereum's trading at about 100 times its buyback, but for something that's growing extremely fast and has a lot of potential, and you could argue on a mid-cycle basis, Ethereum peaked at, call it $22 billion of fees. So on a mid-cycle basis, take the average of peak, and today you're looking at about $10 billion of fees, and 20 times earnings all of a sudden becomes very, very interesting and very attractive. So I continue to be very bullish on ETH, although there are certainly the pros and cons related to how much this will continue to grow, and certainly some worries about activity not growing that quickly at the current moment.
So that's super interesting. I love the way that you just broke down the valuation from like where we are in the current cycle and peak cycle, and kind of got to a somewhat persuasive figure if you kind of take the average of that, which is always good. I'm curious, how do you think about L2s and the potential for them to obviously improve transaction times, reduce fees, but then also maybe take some of those fees away from ETH L1?
Yeah, for sure. Well, look, I think taking a step back, I think it's important to realize that the main criticism of Ethereum to date has been that it is expensive and slow. Let's just be honest with ourselves, and that's because of underlying limits on transaction throughput and its auction-based transaction fee mechanism that scales exponentially with usage. That's really why L2s, such as Arbitrum and Optimism and Coinbase's Base, have really come to play. Their key value proposition is that for users, it's pretty simple. It's faster transaction times and lower transaction costs. And so if you can execute or reach finality 4 times faster than on Ethereum and do it for 20 times cheaper than Ethereum, you're going to do it. And that's why the L2s have seen such tremendous growth in usage and adoption throughout the year as they've launched. I think this is really important on the Ethereum scaling roadmap, and that's why they exist, because Ethereum at its current state can't grow on its own without these L2s. And so any growth in Ethereum almost necessarily has to be via the migration of activity onto the L2s. As far as how you think about cannibalization of activity on Ethereum, there certainly is some. I would say that the goal here is that if L2s enable, call it 20, 30 times transaction throughput, that all that block space actually gets used. And if it does, the net should be that fees on Ethereum go up over time. But in the near term, you are seeing that as more transactions migrate onto the L2s, that Ethereum fees are getting compressed a little bit because of that auction-based mechanism. But none of us are really valuing Ethereum on today's fees anyway. Like I said, it's 100 times today's fees. But if you really look out forward and you think about the growth of the total pie, it can start to get really interesting numbers as the L2 scale. Their batch transactions, obviously, on a per transaction basis, are worth a lot more to Ethereum than any single transaction.
Yeah, Cosmo, I'm really sympathetic to your view. And, we've certainly seen that in this kind of period of weaker activity, certainly the idea that we need all this block space has, from all these alternative L1s relative to Ethereum, I think that idea has kind of gone down. Certainly, I think we're transitioned away from that flat protocol thesis that we had back in 2021, where I think it was a very sure bet to kind of look at the infrastructure of this stuff. Where is this stuff sitting in terms of applications? But we are now past that point, right? I think in a lot of ways, we've kind of built at least sufficient infrastructure so that if we actually have the users, we can accommodate them. Now we're looking forward to what is the super app that's going to take us away from this chasm of early adopters into general usage. And I'm not going to ask you the common question. Everyone wants to know, hey, what do you think that app's going to be? I don't think any of us really kind of know. But how do you kind of navigate that space with that in mind? Because if we're in a new regime where we're trying to trade the apps, what are the things that you're looking at in order to kind of make that happen?
Yeah, look, I'd say that. Again, starting at a high level, I think it's really, I come from a consumer internet investing background, and something I've learned over the last, many years being an investor is that you never know where the big, hot consumer app will come from. It always sort of comes out of nowhere, like a stroke of lightning. No one expected Snapchat to take off. No one expected DoorDash to take off. But when it strikes and when it really starts to resonate with consumers, adoption can be pretty dramatic and very fast. So all that is to say that, the job of a consumer investor is to really look for signs of initial product market fit or inklings that this application may have caught on, and then track the fundamentals very closely, whether it's kind of on-chain activity or basic things that come from TradFi, like going to Google Trends or Sensor Tower, their app balance data, really tracking that closely to make sure that you are starting to see that exponential curve grow. So that's sort of how I think about it at a high level. I think more specifically today, where are we seeing exciting activity? Look, I think right now the applications that found product market fit in crypto are primarily a few areas, right? One is just Blockspace. We talked about that, where the L1s, to transact on a blockchain, you are effectively paying for block space, and so the L1s and L2s, like Ethereum and Arbitrum and Optimism, have generated very meaningful fees, and that is users actually paying to use something. So I would argue that is actually a consumer application. The second is probably trading. I think this is a very core trading, or more cynically, gambling is a very core human attribute that's been around, or core human instinct that's been around for millennia. And so the fact that people like to trade and the fact that people like to transact is natural, and actually a very large and growing TAM, and something that's not going away. And it just so happens that the most frequently used blockchain apps today are indeed trading related, whether it's on centralized exchanges like Coinbase, yourselves, or decentralized exchanges. And so, you're still seeing these trading venues generate very meaningful revenue, whether it's on centralized exchange or decentralized exchange. And then the third area that's really found product market fit is probably stablecoins. Just the need for micropayments and the demand for storing and transferring value, primarily denominated in USD, has been very critical to the financial plumbing across crypto and just emerging markets in particular, with less stable governments and currencies. And a lot of stablecoin issuers are effectively banks. So something like a Maker is effectively a bank that issues a stablecoin and earns a yield on that stablecoin. And those have turned to be, banks are good businesses in rising rate environments, and those have turned out to be pretty good businesses and generating a lot of revenue this year. So those are sort of areas I see a lot of product market fit today. I think looking forward, I'd love to see more, or I anticipate seeing more probably in two main areas. One is certainly gaming and DeFi or gaming and NFTs. To me, it makes, as a former gamer, it just makes so much sense that online game economies should live on chain, and that global or gaming communities are global businesses. And so it makes a lot of sense to migrate that activity on chain in a digital native way. And then the second area is really a DEPIN, or decentralized infrastructure networks, which I found to be really interesting. I think it's really interesting. It's really important to point out that everyone asks, what is the purpose of crypto and why does it exist? I think DEPIN is a perfect encapsulation of what's uniquely enabled by blockchain. I think the superpower of crypto is that tokens are a powerful incentive mechanism to bootstrap adoption. So what that means is tokens elegantly address the dilemma of the cold start problem that a lot of networks have, right? If you have demand supply network, it's really hard to build up both sides of the network first. But once you get it going, it's a really powerful network business as a positive flywheel. And tokens sort of jumpstart that by giving incentives to early adopters to participate in the network. And so you're seeing a lot of really interesting DePIN projects really start to take off. And I think we could see meaningful adoption next year.
Yeah, wow, a lot to unpack there. Definitely want to dive into the DePIN side of things, and also gaming and NFTs. I want to just go back a little bit though and kind of talk about L2s again. And I'm curious for your perspective, what do they need to do to improve that user experience? And I kind of give you this as an example. I'm in crypto, have been for a little while. And I was at an event recently with some other people in crypto, and we just wanted to send some dollars to one another. And you kind of had that moment of bridging to one network, and then making sure you had enough ETH so you could bridge, and then you could fund it, and all that sort of stuff. So for me, I think user experience still needs to improve a little bit, but I'm curious your thoughts and what else maybe we should be thinking about from that perspective.
Yeah, look, I sympathize with that view, and even me, having been in crypto for a long time, the UI still needs a lot of work. And one of the things that has gone, one of the major upgrades to Ethereum that's sort of an unsung win that people haven't focused on is account abstraction, which was enabled earlier this year. But effectively, what that does is, you no longer have to create a wallet to interact with the blockchain, and then you no longer have to have pre-fund with gas to interact with Ethereum specifically, and that's really powerful, right? Right now, today, in order to, or prior to account abstraction, in order for my mom or whoever to buy an NFT on Ethereum, it's a whole ordeal. You have to set up a MetaMask wallet, you have to save a private key, you have to then onboard onto Coinbase or another on-ramp, and then move that into your MetaMask wallet, and then enable permissions, and then buy the token or buy the NFT that you want. That's just a lot of steps. And what account abstraction does is it enables service providers to provide a much more seamless Web 2-like experience for users who want to onboard and don't need to know the complexities of how blockchain transactions work. And so I think anything we can do to continue to abstract away the fact that you are, I don't, in the future, I see a world where people don't realize they're interacting with blockchain networks, just like people don't realize they're interacting with the complicated wiring that goes behind the internet. It's really just, they see applications, they use it, those transactions happen to live on the blockchain, and they go about their daily lives. And I think the more and more we see infrastructure providers or wallet providers enable that, the better. And that's certainly step one, abstracting away the user complexity.
I really like that. And I completely agree. I think that when we get to that world where you don't even know that you're using blockchain, like that's really the big unlock. When we're talking about L2s, though, another big issue that arises is because so much activity is sitting on individual L2s, we create a lot of fragmented liquidity. And I was wondering how you think about that. And kind of a related topic, it's a little bit different to this, is it kind of goes back to the whole modular versus monolithic thesis. Like we're seeing right now that on L2s, there's the building out of kind of developments like Eclipse, which is kind of taking the best of all worlds, right? They're saying like, hey, let's rely on like Solana for its virtual machine, Ethereum for settlement, Celestia for data availability. How does that also play into that user experience you're talking about? Because if we're really kind of just optimizing everywhere now, like how will that kind of change things in your worldview?
Yeah, look, I think there will be multiple states of the world, or there will be multiple blockchains in the future that we use, and different blockchains will be better suited for different applications. So I do see, in particular, I see a state of the world where there needs to be an EVM, or there will be an EVM ecosystem that is pretty modular in its nature, whether it's separating execution from data availability, from consensus. But there will also be a universe or a set of transactions and applications that live on monolithic blockchains that are not modular, that are single blockchain and sort of everything encapsulated in one, that are extremely high throughput. The benefits of the EVM ecosystem are frankly just that they have built up this massive network of users and capital. And so that is a pretty strong network effect that I think is hard to displace. I think if we were to start over, you might argue whether that's the best place to start. But this is sort of where we are in the evolution of blockchain, and that's where the liquidity lives. There are also better decentralization guarantees built that Ethereum has versus monolithic blockchains such as Solana, and so there is a need for both in the future. I'd say, as far as like how I see the EVM ecosystem shaking out, I do think these are network businesses, and I would expect market share to aggregate and concentrate in a few players. That's Ethereum, but under them there will probably only be a handful of L2s, maybe 3, that really scale quickly enough and survive into the future. And then below that, there might be a lot of L3s or app chain specific app chains that get built on these L2s. But to your point, we can't have liquidity fragment infinitely. That just doesn't make sense. Even if cross-chain messaging gets extremely good and easy, it still is less convenient than just everything living on the same chain. And so I would expect there to be pretty meaningful network effects within just a few L2s, the EVM system, and then perhaps another monolithic blockchain system.
Amazing. I love that. I love that breakdown. Just want to move to another topic now and talk about gaming and NFTs. Now, I think a lot of people talk about gaming having not been gamers necessarily. It sounds like you were a gamer, so we'd love to hear a bit about that first. But how do you think about gaming and NFTs, and what are some of the green shoots you're looking for there in terms of early signs of traction?
Yeah, look, I think at a high level, the reason why gaming is so attractive as an end market is that for blockchain technology to really be adopted, we need to onboard the next billions of users. And the fastest growing segment with the highest engagement from users is gaming. They're already digitally native. They're spending hours a day. The average user spends hours a day. And increasingly, gaming is effectively the new form of social media for a lot of people, and especially in younger cohorts. So that's why this is so important to get right, and such an interesting growth area. I would say that next, I would say that it has been disappointing so far, the level of traction that we've gotten in Web3 gaming. I think the idea of frictionless payment rails and frictionless economy makes it, and a frictionless decentralized economy where you own your own assets, is very compelling. The problem is that there just haven't been any games yet that have been released that are very fun to play, and that's only what it comes down to. For a game economy to work, effectively you need the game economy to make money. And so what that means is you need more inputs or more capital coming in than capital coming out, which means people have to be playing the game to play the game and generate utility, and be willing to pay to play, as opposed to be just playing to earn and taking money out of the system. I'm going back to that trope about consumer investing. You never know when games are going to break out or consumer apps are going to break out. I'm pretty confident that there are a ton of teams with a lot of capital developing games, or developing quote unquote AAA or maybe AA games that will be released next year. And so I'm hopeful that one of them will hit, but it's really hard to know beforehand which of those games will hit.
So when I talk to a lot of game developers, at least on the Web3 side, one of the challenges, of course, is trying to find that balance between network effects and financialization. I don't think there's any consensus on this other than Axie Infinity wasn't a good model to follow. People thought that it was good in order to kind of open up the space, but other than that, everyone's trying to come up with something new. Have you seen any economic model that you think is sustainable in this space?
Well, so I think it really comes back to, I think all the tools are there. So I don't know that there needs to be a new economic model that's created, right? If you just go back to existing games, let's say as an example, so World of Warcraft, at peak, it was about a 800 million GDP business, right? It was an economy that generated about 800 million transactions across its network on an annual basis. That's pretty interesting. What is that? And that's excluding the dollars that were spent on World of Warcraft subscriptions, which 10 million users times, call it $120 a year, is another $1 billion of revenue. And so there actually are massive in-game economies that exist today. They just haven't been unleashed in a Web3 way, or they just haven't been built on the blockchain, and so they haven't been really unleashed. If anything, the WoW economy was held back because Blizzard and Activision Blizzard and other game developers like them didn't like the fact that there was money leakage in their game, and that there were, in fact, a huge economy of what farmers, they called them farmers back then, just like farmers in Web3 games, but like farmers effectively mining whatever kind of resource they want to use in the game, whether that's gold or ore or pelts. And there already existed a massive economy of people that played the game to make money, and then they sold their goods to people who played the game to have fun. And that was a massive economy. And so it all comes back to the tools, I guess, basically going back to the fact that the tools already exist. It's really just creating a game that's actually fun so that we can have the inputs be greater than the outputs. That's
great. And back to my first question, what was the game that you were playing when you were gaming a lot?
Yeah, I was a big StarCraft player, and then Dota, or Defense of the Ancients, and I played a little bit of WoW during COVID.
Very, very cool, very cool. So I guess if you're playing those games, I'm assuming you have some in-game items which may or may not have value today. And is that kind of where you see NFTs coming in?
Yeah, that's exactly right. I think the real benefit of NFTs is twofold. One is that they are a digital representation of your good, and so you can actually verify that you own those assets on chain. And two is that they're immutable. I think there's some debate on whether NFTs need to be immutable, and I'm okay with dynamic NFTs versus immutable NFTs. But the fact that you own an item, you know what it's going to do into perpetuity is pretty powerful, and incentivizes you as a gamer to spend more on that item. If I knew that my item belonged to me, I'd be willing to pay more for it. That's just how it goes. And I do think that whether in-game items, whether it's in-game resources, maybe are more like tokens or currency, and then in-game items like weapons or armor are more like NFTs that are immutable. I think that's a very interesting way to digitize and put gaming assets on chain.
That makes a ton of sense. Now, moving on to Deepin, I have to say I kind of agree with you. It's an area that I'm pretty excited by. Seeing the Hivemapper stats recently, they've mapped 8% of the world's roads in 8 months, and like that. There's questions around quality of data and what it's used for and demand and stuff like that. But like to your point about an incentive within a network, for me that's huge. So curious, where are you most excited within the Deepin space?
Yeah. Look, I have to emphasize again, it's really all about the superpower of crypto is that tokens are powerful incentive mechanisms. And so exactly stuff like Hive Mapper is extremely interesting where drivers install cameras on their cars to map the world around them, effectively building a competitor Google Maps. And they're in token incentives for applying that mapping data to networks. You know, hopefully, in theory, in the future, as they build out a more dense network or better mapping data, they can sell that mapping data to enterprises who want to buy, who need the mapping data. I think another area that's particularly topical right now, and I think we're about to see a lot of adoption is decentralized compute. You know, an interesting way to use token incentives is to tie those token incentives to real world work. And the most successful examples of that so far are using what is effectively excess capacity that otherwise would be hard to coordinate. So in the Hive Mapper case, you're already driving your car. Why not have a camera on your car, also map data as you're driving? Another area that people have found, or you know, entrepreneurs have found, is there exists excess capacity is actually in GPUs. Right now, as I'm sure everyone knows, there is a massive GPU shortage and a supply-demand imbalance in the GPU market because of the huge rise in usage for AI. GPUs are particularly good for AI training and inference, and therefore their usage and demand for GPUs has gone up massively this year. You see this in NVIDIA's earnings beating and raising 20, 30%, both in the last couple quarters. And so it's very clear that there is a need for increased GPU capacity. There are really interesting GPU networks being decentralized GPU networks being spun up today, such as Render and Akash, which are effectively providing a marketplace where GPU providers, whether that's small hobbyists or guys with just gaming computers that have really strong GPUs, or hobbyists with small data centers, or even sneakily some of the larger data center providers supplying their excess GPU capacity onto these networks. And on the demand side, whether it's academics or scientists, or even end use consumer AI inference models, they are accessing these decentralized GPU marketplaces like Render and Akash to actually do their AI training and inference. So this is all really exciting because I think this is a perfect example of how token incentives are uniquely used to tap into excess capacity that lives in a very decentralized network. These GPUs are coming from across the world, and they're coordinating them to actually be used to do real world work. And it happens to be very timely just because we do have such an acute supply-demand imbalance in AI compute right now.
Amazing. That's certainly a ton of very, very exciting projects there. And I feel like these things take a long time to build up. I'm curious, Solana is kind of involved in that space, and it's been around a little bit longer. It's often seen as a bit of a hedge against ETH and L2s in terms of the way that they operate. I'm curious kind of how you connect the dots there between Deepin and Solana, and how you think about that in reference to Ethereum as well.
Yeah. I think what we've seen is that Solana has been kind of a sneaky winner in all of this. A lot of the Deepin projects, whether that's Helium or Render, have moved on to Solana recently because they've realized that they need a blockchain network that can support high throughput. And Solana happens to be one of the best options out there. It also helps that they share a lot of the same investor base, and so everyone is really incentivized to both grow the Solana network as well as these specific Deepin projects. I think this really goes back to why do monolithic blockchains need to exist? And the reality is that something like a Solana or other monolithic blockchains really do enable quicker throughput or faster throughput today. And these projects, want to grow today, and so they're finding a lot of success migrating over.
I want to move on again. So we've spoken about one of the areas that's got product market fit is trading. We've spoken about the value of decentralized networks. Kind of want to put those two together now and just talk about some of the decentralized trading platforms, perhaps specifically. It's not an area that we're particularly close to, so I'm curious for your thoughts and how they're growing, what their volumes are like relative to centralized, and I guess what you see for the future of those types of platforms and products.
Yeah. So decentralized perps or decentralized perpetual futures contracts have been some of the fastest growing and most money making applications in crypto in DeFi today. Why is that? Derivatives, and in particular, perpetual futures contracts have become the main way that crypto is traded. Derivatives trading volume is about 3x that of spot volumes on centralized exchanges. And so that is clearly where people choose to trade. Why? The answer is pretty straightforward, which is that futures are a much more capital efficient product to trade than spot. And so it's no wonder that derivatives trading volume has really taken off. And I would expect that to continue. In the traditional financial markets, derivatives markets are 10x or more the size of spot markets. At least in notional trading value. So the reason why decentralized perps exchanges are interesting why these exchanges need to exist in DeFi is there are a couple of reasons. One is that a big appeal of DeFi is that you get to the whole concept of your keys, your coin. The fact that you actually continue to have custody of your funds on chain. This is particularly relevant after last year's famous industry blowups. Where a lot of users realized they actually didn't own their money. They were just a ledger and a balance sheet, and that they did not have claim to their unsecured creditors effectively to these exchanges. These are the shadier exchanges, not Coinbases of the world, but the fact is a lot of exchanges are like that. And so the ability to have custody of your assets on chain, which a lot of people take for granted in tripartite custodial agreements and TradFi, is not so obvious in crypto. So that's one. The second is just that DeFi, the promise of DeFi is permissionlessness. What does that mean? It's a more convenient way for a global audience to access these assets. It's much easier to get spun up and start trading on something like a DYDX or GMX or Uniswap than it is to open a new exchange account. And so that's very interesting and easy for a lot of people to move funds in and out. Where we've seen a lot of success then is in the growth of perps exchanges and then DeFi perps exchanges as a result. The first perps exchange I would say is in DeFi was DYDX, which has a very dominant 60% market share today. And then there are other large contenders like GMX and Synthetics who continue to exhibit pretty meaningful growth as well.
Amazing. Cosmo, thank you so much for all of that. I have like another 25 questions. I could literally continue to ask, but alas, we better move on. I know you're busy, but we will keep you involved throughout the call. If there's anything you want to add throughout the call, then please just jump in. But thank you for that. That was super insightful. And as I said, I'm sure I'll have follow-ups for you offline as well. George, back to you for the rest of the market news, please.
Yeah, sure. Thanks. Definitely been a couple of interesting headlines over the last week. Obviously, a lot of interest in the ongoing FTX trial from the crypto community. One of the most interesting headlines I saw, among other things, was Gary Wang saying that the insurance fund number was essentially made up, which is interesting. And then Caroline Ellison speaking next. So we'll probably hear a couple of other interesting insights there. Onto more positive things. CoinShares reported the largest weekly inflows since July into crypto ETP products. So it was about $78 million last week, actually mostly into Bitcoin-related products. And you were talking about real-world asset-related projects earlier, Ben. So crypto company Backed has issued a tokenized security product on Base, which is very exciting to see. And it tracks essentially a short-term U.S. Treasury bond ETF and is collateralized by the underlying bills. A couple of other things to watch out for, which I'm sure David will touch on as well. We have the US CPI coming up on Thursday this week, the Grayscale appeal deadline on October 13th, and there's a Binance SEC hearing scheduled for Thursday, October 12th as well. So definitely watch out for any headlines there.
Thanks, George. Yeah, reading those headlines around FTX and that number, how it was created, was just like head in hand stuff. It was unreal. But anyway, as you said, moving on, great sequence, you're seeing decent inflows there. And then on real world assets, I think Sid is going to touch on it later. There was something happened on one of the platforms there, which you want to cover as well. But thank you very much for that, George. David, macro. what are you focusing on at the moment?
Yeah, so I think the interesting thing about macro is that macro is definitely having more of an impact on what's going on in the crypto world. And that's kind of been a regime shift that hasn't previously been there over the last few months. Now, that said, the correlation between something like Bitcoin returns and S&P or NASDAQ returns is still fairly low to the point where we can consider them uncorrelated, but it has been rising over the last few weeks. So directionally, we think that their chances of them moving more in tandem is actually increasing. But what we have seen driving the picture has been high yields in the long end of bond curves. And that's not just the US Treasury curve, but that's pretty much across all like global sovereign bond curves. But something has changed. We have, for example, come full circle on rate hikes. So I think that a week ago, the consensus that the higher rates were just unstoppable here, at least through the quarter. And it was just decoupling from traditional indicators like the copper to gold ratio. Now there are two things that are kind of changing that. Number one, there was the conflict in Israel that, people have been kind of retrenching back into safe havens. So bond markets are kind of seeing that the yields coming down because of that. And also because, just global like financial conditions, at least national financial conditions in the US, have tightened so much over the course of last month, in part because yields have been rising so much. The Fed has kind of stepped back from the commentary that they previously had. Just on Friday, when non-farm payrolls kind of beat so much to the upside, I actually thought, I was like, wow, it seems inevitable now that the Fed's going to need to kind of step in here and hike rates in November. Quite the opposite. In fact, the odds of a Fed hike are now down to around 12% because the commentary coming out of a lot of the board members has been that actually, because financial conditions have tightened so much, they don't actually think they need to do anything. So it's going to be interesting come November, because I think previously I had a lot of conviction that, because the Fed was going to stay put, very likely we would see things kind of rally. But just now, so many things are going on, like, because of this, war in Israel, for example, maybe global growth might be more suppressed. Generally, equity and risk assets really like growth. So if that's going to come sooner, like I thought that wouldn't happen until there was this kind of natural easing into the first quarter of 2024. Now these kinds of geopolitical stress points have kind of moved that somewhat forward. But for the time being, it seems that what is dominating the performance of these assets is just this huge imbalance of market supply and demand. So that tends to be the name of the game. Probably the next big thing to kind of materialize, at least from the macro standpoint, is what's going to happen with US CPI, as George kind of pointed out. If that kind of surprises again to the downside, and markets are expecting that core CPI is going to come down to around 4.1%. If that trend stays put, then maybe we will get this kind of environment where the Fed isn't going to do anything in November. And maybe, I think things could still materialize to a rally for crypto into year end. But certainly my conviction on that, which was very strong, just even a week or two ago, has moderated somewhat. But I still believe that rally is going to be in place.
Great, thanks, David. And I guess some of the crypto-specific data points that might affect that rally is around Grayscale and ETFs. So we'd love to bring Greg in here as well. David, you first. How are you thinking about that kind of Grayscale timeline and other ETF timeline as well?
So the interesting thing was, I think we saw there was a headline from a former BlackRock executive who was saying that the most likely scenario now is that we won't just get one Bitcoin spot ETF, but very likely we'll get a grouping of Bitcoin spot ETFs. And I think already markets were kind of moving in that direction. I think for the most part, a lot of pundits were arguing that was going to be the most likely scenario. The timeline, I think, has in fact been moved up because of the deferments that the SEC did. So, we saw right before the questions about the U.S. shutdown were going to appear, that a lot of these decisions were postponed until early January. So around those dates between January 3rd to January 10th is where we think the SEC would have the final deadline to actually confirm or approve or deny these applications. But because that would kind of run into the beginning of the year, I think a lot of people believe that would happen probably within Q4. So I think that's something that it's more important now to kind of establish whether that's going to be the case or not.
Got it. And Greg, from your perspective, how are you thinking about it, and how are clients talking about it typically?
Yeah, I think David's right on the timing. We have, Friday the 13th coming up. October 13th is the day we're going to find out whether or not the SEC appeals the Grayscale case. That's going to be, big news and will inform the timing. But assuming there's no appeal, it's any time between, just after then and early January, and likely to come in late Q4. So, lots to look forward to later this week.
And are you, Greg, are you seeing people positioning, or is that positioning being done? Like, are people lightening the load a little bit? Like, how are people thinking about it, and specifically to the GBTC and ETH products as well?
Yeah, so in both of those products, the discounts have remained about in line with where they've been, when we've talked about it on past shows. So that's, call it 18% in GBTC, 30% in ETH. As far as positioning in spot markets, I would say, absolutely people are either positioned for it or they don't want to miss it, which means they don't have a full position on, but they're there. And the reason, we think that is Bitcoin has really had this persistent bid really since late August. And it's had this bid in the face of, weaker risk assets, weaker, overall crypto markets. So for sure, I would say, traders are there and, betting on a positive outcome Friday and later this year.
Awesome. Thank you. Thanks so much, guys. David, appreciate your update on the macro there. That was fantastic. Greg, going to stick with you here. In terms of flows, what else have you been seeing on the desk?
Yeah, so volumes have, settled in and remained pretty stable. I have to say, listening to Cosmo earlier in the show, you got me all bulled up, which is a great feeling after some of the de-risking we've seen in the past week, especially in the longer tail assets. Again, Bitcoin's held up really well because of that ETF bid and catalyst, but also more recently, it's had a bit of a flight to quality move where we've seen people rotate out of, even ETH and into Bitcoin, but also some of the longer tail assets. So it'll be something to keep a close eye on to see if that continues. Now, one other thing from a technical standpoint, and we talked about this last week as well, I think we have a chart on this if we want to bring it up, is, Bitcoin has been rejected at this $28,000 level several times. George mentioned it earlier in the show today. That is where the 100-day and 200-day moving averages kind of converge. And it's something that we're watching very closely because I think if we do get positive news on Friday and we trade up but aren't able to, retake that level, I think that should give a lot of us some pause as we move into the, later, well, not the later half. Oh my God, it's into Q4 and the end of 2023.
Wow, so it feels like we have a lot riding on Friday. So, tough question, but is there a particular time that we'll expect to hear that these things will come out, or is it like close of business, is no news is good news type thing?
I don't know the answer to that. In the past, we've sometimes heard that morning, we've sometimes heard the day before. But I don't know if there's a firm deadline. I would imagine there is, because it's the U.S. court system. But that's a good question that I don't know the answer to.
Cool. We'll look into that one and come back. Cool. Thank you very much, Greg. Appreciate that as always. And Sid, welcome back.
Hey.
There's been a lot going on. I know you've been very active in Frch. So looking forward to an update there. But maybe let's kick off with Arbitrum. I think there was some news out there that's worth talking about.
Yeah, definitely. I know we touched on L2s a little bit earlier in the call. Obviously, Arbitrum probably one of the biggest L2s out there in terms of TVL and the sheer number of protocols deployed on there. Had a pretty big update this week where there was a governance proposal out to allocate ARB token incentives to protocols on the layer 2. There was a bit of, if folks remember, there's a bit of scandal earlier in this year when the Arbitrum DAO kind of arbitrarily had a proposal to allocate a certain proportion of the token for incentives without governance voting, and folks were kind of in uproar about that, so they rescinded that. But now this is up for governance. It's on the governance forums. In fact, it's so geared towards governance that there are like 97 different projects looking to get ARB incentives, and a flurry of activity on the governance forums about this. There's a snapshot vote live. It's running until Thursday, October 12th this week, and loads of projects getting positive voting that we're seeing from the initial results so far. Overall, they're allocating around 50 million ARB tokens for incentives, and projects are kind of just angling to get a portion of that for their individual use cases, and voters who are ARB token holders are the ones kind of deciding the fate of this. So net, it should be a positive for the ecosystem, because historically other L2s and L1s who've had these kind of programs have generally spurred activity and users bridging over to the chain and using these apps to get a portion of these incentives. So we'll see how Arbitrum reacts.
Yeah, it's definitely a competitive space out there. Cosmo, would love to bring you back. Obviously, we spoke about L2s. We've spoken about, I guess, in general, more broadly, kind of how competitive the space is and how you've really got to compete to get users to transfer across to your L2 or your L1 or whatever it might be. I'm curious, with this one specifically, how are you thinking about this situation?
Yeah, I'd say I'm very bullish on L2s in general, but in particular Arbitrum on the back of this news. For those who have been following the ecosystem for a while, it's been known that Arbitrum does have a lot of capital in its treasury, and it has been wanting to deploy that to incentivize people. But it's gone through the hard work of coordinating people and decentralized in a DAO to actually make a decision and get this program in place. In the meantime, this whole year, they've been competing against a lot of other L2s that have been pretty aggressive about using incentives. And so I do see this as and despite Arbitrum not really having an incentive program since launch, its activity is by far the most active on an organic basis. And so that's very exciting. And now they get to just step on the gas by adding these incentives, and the applications that are going to. So Arbitrum itself, I think it will be very interesting because you are going to start to see a real inflection in growth and them start to gain market share again, where some critics or the bears on Arbitrum have said that they've been share losers, when the reality is I think that's misinterpreting the data and certainly will be wrong going forward. And then within the ecosystem, there are a lot of interesting ways to play this beyond just Arbitrum. Clearly, the largest applications on Arbitrum are going to receive pretty large grants. So whether that's someone like a GMX, which is a decentralized perps exchange, similar to what we talked about before, or Grail, which is another decentralized spot exchange, they are getting very large grants. And I would expect to see, and they are fee earning, they return fees to their token holders. And I do see them outperforming over the next stretch as these grants get rolled out.
Interesting. So, Cosmo, you're saying that the grants get rewarded to GMX and they then in turn reward it to their users?
It's a little bit less direct than that. So GMX is going to get this Arbitrum grant, and what is likely to happen is they are going to use that in a few different incentive programs. One is to bootstrap more liquidity, so incentivize liquidity providers to come to GMX and increase liquidity, which increases trading depth and enables greater volumes. The second is they will to a slightly smaller extent incentivize trading activity, right? By lowering effective trading costs to be more competitive with centralized exchanges, and in that way drive more users onto the exchange.
Very, very cool. Very cool. So one to watch there. And Sid, what is the actual date that this is going to be distributed?
Unclear yet. I mean, first this governance has to go through, but within the next few weeks, the snapshot proposal ends on Thursday, and then after that, there's a few more stages.
Got it. Okay, fantastic. Back to or moving on to Frch. What is the latest here? I know you're still very active. What's going on there?
Yeah. I mean, speaking of protocols and dApps, right? I mean, that's the holy grail where crypto is looking for dApps that can drive user activity and retention. A lot of these incentives are for that. And Frch was one of these apps that kind of sparked folks' imagination. It was launched on Base, and spawned a new category of social fi, right? And so last week, it breached, the TVL breached $50 million. It's sitting at around 43 million now. But what it really inspired was a bunch of different clones and copies of Frch across different chains. There was one on Arbitrum. Last week, we also saw one on Avalanche called Stars Arena. Unfortunately, Stars Arena, suffered an exploit of $3 million, and they eventually managed to plug the hole, but still confidence was a bit shaken. And generally speaking, I mean, the topic of security has been a conversation topic amongst Frch, for the past few weeks, especially as folks have been piling more and more ETH into it. It's using kind of a relatively new dApp architecture with this Privy and then progressive web apps, which is kind of living on the phone, bypassing the app stores. And folks are wondering how secure is it, especially when they're logging in using their Twitter credentials and phone number and things like that. And some folks had been SIM swapped and attacked on Frch. So recently, this past week, Frch announced the ability to add like a 2FA password and like add and remove login methods as well. So some improvements to the security. And in contrast to some of these other clones where exploits are happening. So it's a positive for the original Frch ecosystem for sure. But again, it remains to be seen how lindy and how resilient the core code base is as time goes on.
And have they improved any of the kind of early concerns around tokenomics and how many people can hold a key given the kind of the curve, the bonding curve?
Yeah, so the bonding curve remains the same. It's actually hard to change that one. But they did, every week, basically, for context for listeners, the Frch has been airdropping these points on users. The points have no material value at this point, but, potentially they do down the line. And that's been hinted at by the Frch team. And historically, users were getting points just based on the amount of the value of their portfolios, and so users figured out that they could just buy themselves quite a lot to have this total value locked metric, and then kind of game the point system. And the Frch team seems to have cut down on that. So people who are self buyers don't actually get the same equivalent number of points as people who spread out their buys across other keys. So we're seeing more distribution of keys on the network, and just trying to incentivize more organic behavior. So we'll see how that plays out.
Fantastic. Very, very cool. As Cosmo said earlier on, some of these things with green shoots are the ones to keep an eye on. So thank you for doing that, Sid. And then what else have you been looking at? I know RWAs was an area that I think there was something you saw there.
Yeah. I was at a conference last week in London called the CC Data Conference for Crypto Compare, the data company. A lot of the conversation was around RWAs and specifically on Maker, where the total RWA portfolio is over $3.1 billion now. With DAI supply steadily increasing, and obviously US interest rates, that's still a pretty dominant source of revenue and one of the leading revenue generating protocols in all of crypto. On the flip side, also this past week saw some slightly negative news in terms of this space in general. There's a protocol called Goldfinch, where it specializes in like real world lending pools. They have several different baskets where folks can deploy capital, which is then deployed to real world companies. So they have like baskets like a carbon reduction pool, an African innovation pool, and so on and so forth. And this past week they had like a $20 million loan that they had lent out to several real world companies kind of go bad just because the companies didn't do so great. And so the company behind Goldfinch called Warbler Labs, they've stated that they will actually backstop this, but also highlight some risks in terms of on-chain credit and this association with real world assets, how resilient these loans are is a subject of concern. We'll see how that plays out.
And do we have any sense of how much they're getting back on the dollar? Is it 0 on the dollar or 50 cents on the dollar for this 20 million loan that went bad?
No, they charge pretty high interest rates. So basically, I mean, each of these pools, capital is kind of allocated into these pools, and then from these pools, it's allocated to several different companies by different borrowers. So in this case, there's a borrower called Stratos Asset Management, and so the pool itself as a whole has APRs ranging from like 7 to 10%, depending on the pool, and then so there's like the base kind of interest rate, and then on top of that, depending on the risk taken by the pool.
Perfect. And for this $20 million, that loan has defaulted entirely?
Partially, and then some of it is getting clawed back, et cetera, and then Warbler Labs itself is backstopping as well. So
got it. Okay, so I'll get the full amount, but unclear what the delta is between what naturally comes back versus what Warbler Labs has to cover.
Yeah.
Interesting. Great, fantastic. And in terms of fantastic, okay, Cosmo just put something in the chat. So let's bring you in here. So these claims are trading on chain, Cosmo?
Yeah, it's actually kind of interesting. I mean, part of what's really cool about Goldfinch and these other real world asset, they're effectively credit underwriters, right? Loan originators, is that they actually tokenize their loans and they put them on chain. So you are starting to, you can trade these claims or you can trade these loans on chain, and you're starting to see some activity there. I think there was another Goldfinch loan that defaulted a little while back, and those are trading at about 70 cents on the dollar. People are hoping that recovers are closer to 90. And I haven't looked at this one or this most recent default specifically, but I think it's about a $7 million loan as part of the 20 million CLO-ish product is what defaulted. And so you can definitely go on chain and start to play these claims if you have a differentiated view on how the recoveries will work out.
Very cool. I love how that's suddenly available. I was just doing a bit of Googling. So one of them was a decentralized lending protocol in Kenya. I don't have much of an edge there, so I may leave that one alone. But it's interesting at least to have the ability to do so. Cool, awesome. Well, I think that's it for this week. Cosmo, thank you so much for joining. That was a lot of fun and really insightful. Thank you, Sid, George, Greg, and David. Fantastic as always. And thank you all for listening. We will see you next week. Take care.